Market, stock, options, futures, dividends, returns, bull, bears, shares, derivatives, high, low, index, Sensex. I am so confused. These terms are echoing all around me these days. Everyone is talking about the market. Will it go up? Will it go down? The other day, I even heard my bhaji wala discussing it with my doodh wala. That did it. I decided it was high time to become street smart. Dalal street smart, that is. So all my reading, learning, browsing is going to be compressed into 3 minutes of Gyan just for all you beginning investors out there. Let's begin with the most basic principle. The two primary asset classes are equity and debt. Equity or stock is essentially ownership of a share of a company. If you buy Infosys stock, you own a teeny tiny piece of that company. In fact, theoretically, you own a share of each rupee of profit the company makes. And the more you invest in the company's stock, the larger is your share of the profit. Debt, on the other hand, is a loan that you give to governments or corporates. In exchange, they promise to return your money after a fixed period of time with a fixed interest rate. This product can take various shapes and forms: fixed deposits, bonds, etc. But the basic concept remains the same. This is a very low-risk product because you have a guaranteed return of your money. The stock market is literally a marketplace for the trade of various equity products, predominantly company stocks. The purpose it serves is to benchmark on a daily basis what investors and traders believe a stock's value should be. All factors, macro and micro, relating to the market and the company are factored in through this process. This constant re-evaluation is what creates risk, as the stock price can swing in either direction depending on how it is viewed. Thus, stock is a higher risk and a higher return product. The financial field has been a hotbed of innovations. As more people enter the market, more products are needed, so that more money can be made all around. Thus, investment bankers have created various other financial products. These products are called derivatives, since they are derived from equity or debt products. Some examples of derivatives are futures and options. Essentially, these products allow you to buy or sell a stock, or the option to buy or sell a stock at a future date and rate. Other investment options include insurance, real estate, gold and art, but we'll leave these topics to another day. Now, having explained the basic elements that the market is composed of, I want to highlight a simple but crucial concept in the process of investing: asset allocation. Think of it as your primary strategy to build a diversified portfolio. The goal of asset allocation is to figure out what portion of your portfolio will be invested in different asset classes, such as stocks, bonds, and cash. As you develop your asset allocation strategy, keep in mind that generally speaking, the younger you are, the more risk you can take, so your aim should be to grow your portfolio. As you get older, you should reduce your overall risk and aim towards capital preservation. It is also important to look at your assets in totality. As some asset classes, such as stocks, grow more than others, you have to reallocate to stay aligned with your overall allocation strategy. For example, if you start with 50% allocation to equity and the stock market goes up and your equity portfolio doubles in 3 months, your equity exposure is now almost 75%. Keeping a track of this and balancing this on a regular basis can be critical to your financial returns. Investing can be a risky business, but that risk can be managed with diversification. So have a plan, invest wisely, and have fun. I now have discussions on investment strategy with my cable guy and newspaper guy. They come to me for advice. This is Ishwari signing off, and I'll be back soon.